Good evening, everyone. My name is Mike Scott. I'm a partner in our real estate and finance department. I'll be moderating today along with my partner, Liam O'Connell, a member of our labor and employment practice group. With us are a number of our colleagues that Liam will introduce in a moment. But before we start this presentation, we know it's a difficult time. We want to thank you for joining us. We hope that you, your families, and colleagues are well and safe. Liam and I are co-managing partners of Nutter, and like you, over these last couple of weeks, we've been engaged in planning exercises for our firm as we navigate through these challenging times. Our team has been working with our clients and addressing matters arising from the implications of the COVID-19 virus. The CARES Act, which we'll be discussing today, is the largest stimulus or perhaps relief package in the history of the United States and covers a breadth of industries, sectors, and individuals. We appreciate that there's many demands upon your time, and we hope to cover the issues that are most immediately relevant to you in the time we have allowed. Liam, I'd like to ask you to introduce our team of presenters.
Well, thank you, Mike, and thank you all for attending. We have several members of the Nutter team that will be speaking on various topics today. Paul Ayoub and Beth Mitchell from our commercial and real estate finance practice, Tom Curry and Mike Krebs from our banking and financial services group, David Rubin and Laura Martin from our labor and employment and benefits group, Melissa Sampson McMorrow is the chair of our tax department, and Shannon Zollo is also on the line from our mergers and acquisition group. Briefly, I'd like to review the agenda. In the time allocated, we're going to try to make use of the time wisely to cover some topics that we know are of interest to you all. We will cover the $350 billion Paycheck protection program. We will cover the programs to expand lending to small and mid-sized businesses in conjunction with the Federal Reserve. We will speak to the commercial and real estate finance implications. Briefly discuss the expansion of unemployment insurance relief, and then also address tax relief issues. We're going to start with introduction to the PPP, the Paycheck Protection Program, address the public policy objectives. We should note that on March 29th, there was a Nutter advisory issued on that you can find on our website. But our panel today will cover the most important topics, explain the forgiveness provisions, and discuss some of the questions that we have received both in advance of this webinar and then generally from clients. And so with that, I'm going to turn over the program to my partner, Mike Krebs, from our banking and financial services department.
Thank you, Liam. So good evening, everyone. Let me get right to it. The Paycheck Protection Program, or Triple P, is a hugely significant element of the Stimulus Act. It's probably one of 3 or 4 most important ways that Congress has sought to provide funding into the economy, taking advantage of the existing interconnections between companies, employees, vendors, lessees, landlords, etc. So without delay, let me get into it. As was mentioned, it's roughly $350 billion in guaranteed loans to small businesses. The program is structured as a loan, but in reality, for many participants, it will end up looking like a grant. So there's the opportunity for the loan to be forgiven, and we'll talk about that. The loan is being funded, or funneled, I should say, through banks, credit unions, and potentially other lenders. There are a few important concepts. One is that the period covered. The period covered during which you can apply for a loan is the period ending June 30th, 2020. Who's eligible? Business concerns, not-profit organizations, veterans organizations, tribal businesses. that meet just a few criteria. You had to have been in business on February 15th, 2020. And generally speaking, you have to meet a threshold for, or you can't have more than a specified number of employees is the best way to think about it. For the most part, for most companies, that's going to be not more than 500 employees, but there are circumstances where you may be able to have more employees depending upon the industry in which you operate. We'll talk about that in a second. For counting employees, your part-time employees and temporary employees count equally with full-time employees. Also eligible are sole proprietors, independent contractors, and self-employed individuals. We refer to those these days as the gig economy workers. Two important caveats that my partner Beth Mitchell will discuss. The first is there are some existing rules under the SBA administration, Small Business Administration, or SBA regulations that apply to commonly controlled companies. And in many cases, you have to think about your number of employees together with affiliated companies. And then there's a special exemption for certain businesses. Beth, would you take us through that, please?
I'd be glad to. So, as Mike mentioned, the SBA has some complex affiliation rules that generally require businesses under common control or otherwise affiliated to aggregate their number of employees for purposes of determining whether the business satisfies the size standard in number of employees established by the SBA. So, for instance, if two companies are under common control, or if one company owns a majority of the ownership interests in another company, those employees would be aggregated. Control is typically defined as the possession of the power to direct or cause the direction of the management policies or activities of a person or entity, whether through ownership of voting securities, by contract, or otherwise. There are, however, some exclusions, and they are particularly for the food services and accommodations sectors, those having a industry code beginning with a 72. For those companies, the 500 employee limit is typically applied to each physical location and not the company as a whole. So, for instance, if it is a chain of restaurants, you can look at each restaurant and the number of employees individually as opposed to aggregating them. There's also an exception for franchises so that the franchisee and the franchisor are also not aggregated, but these exceptions are fairly limited. Mike?
Thank you, Beth. So moving on, I want to cover one more nuance about eligibility. If you have more than 500 employees, you should ask the question, am I covered under the SBA regulations that allow for small businesses to continue, or that allows for a business to be considered a small business even though I have more than 500 employees? And if you meet that criteria, then you're eligible under the PPP program. Examples of that are shown on the slide where, for example, you're a cookie or cracker manufacturer, you may have upwards of 1,000 employees. If you're engaged in the utility distribution, so electric power distribution, you can also have up to 1,000 employees. And so before you conclude that you have more than 500 employees and therefore you're not eligible, you should at least think about the industry in which you operate and whether there's a special rule that would apply. Moving on. If you're familiar with the SBA lending program generally as it existed before last Friday of last week, much of that will not be relevant to the PPP program. So with the exception of the affiliation rules that Beth just discussed, this is a whole new game, and the policy objectives are very different. So for example, previously, an SBA loan applicant had to worry about demonstrating the ability to repay the loan. Typically, there was a personal guarantee and collateral. Typically, the borrower had to demonstrate that they could not obtain credit elsewhere. None of those things apply to the PPP program. Instead, the main underwriting standards are that you've been in business on February 15th, 2020. You've had employees for whom you've paid salaries, and you're required to make good faith certifications, 3 of them. The first is that the loan is necessary due to uncertainty of current economic conditions caused by COVID-19 in order to support your ongoing operations. Secondly, you're acknowledging that the funds will be used to retain workers or make mortgage, lease, and utility payments. And then lastly, that you don't have an application pending for any other loans under the SBA program. How much can you borrow? Here, it's important to understand the definition of payroll costs. And the loan that you can borrow is 250% of your average monthly payroll costs during the 1 year before the loan is made, or $10 million, whichever is less. So, no more than $10 million, and if less, 2.5 times your average monthly payroll costs. And what we've been telling clients is the statute speaks in terms of for the 1 year period ending before the loan is made, and that may be sometime in the middle of the month. So for purposes of evaluating your position, just use the 12-month period ending March 31st, 2020. That will get you close enough. So payroll costs are salaries, wages, commissions. We've had clients ask, well, are bonuses included? Yes. If your business involves cash tips or the equivalent, those are included. Severance, healthcare benefits, including insurance premiums, covered leave, retirement benefits, and this is an important distinction, state and local taxes related to employee compensation, but not federal taxes. So your federal payroll taxes, FICA, FUCA, those typical payroll taxes are not included in payroll expenses or payroll costs. So there are special rules for sole proprietors, independent contractors. Their payroll costs are defined to include their net income from a business up to $100,000 prorated. That $100,000 number comes through in a variety of places, I think, in the statute is the best way to think about it. So next, there are some exclusions from the definition of payroll costs. These are important. So we see again the $100,000 cap. Here, compensation to any individual employee in excess of $100,000 annually is not included in payroll costs. It doesn't mean that all of the compensation paid to that employee is excluded, only the portion in excess of $100,000. Then I mentioned federal payroll taxes are excluded, compensation to employees whose principal place of business, whose principal residence is outside the US. And then there's a special rule for qualified sick or family leave under the first Coronavirus Response Act. What can you use the money for? It's a very broad list. Payroll costs, costs related to continuation of healthcare benefits, etc., payments of interest on any mortgage obligation, rent, including rent under any lease, utilities, and interest on any debt obligation that was outstanding as of February. Here, this is important, and our advisory touched on this just a little bit because it's complex. I'm going to try and go into this in more detail. So when might some or all of the PPP loan be forgiven? So this is complex, bear with me. So you're eligible for loan forgiveness on the amount spent by the borrower on specified expenses during the 8-week period after the loan is originated, but never more than the amount of the loan. Then there are certain instances where forgiveness is adjusted based upon certain factors. And I'll sort of pause here just to digress. Many of you know that under the federal tax regime, if there's a forgiveness of debt, that can be treated as income to the borrower. Here, the statute specifically excludes that from the borrower's gross income. So there are no adverse tax consequences to forgiveness. Now let me pivot and move into some of the more complex aspects of forgiveness. So first of all, what are the specified expenses? They're those payroll costs we talked about. So remember, there are things that were specifically included as permissible payroll costs, and then there are things that are specifically excluded. And remember, an important exclusion is compensation for employees in excess of $100,000. Also permissible costs are payments under lease obligations in effect before February 15th, on or before February 15th. Utility payments, and utility is broadly defined. So what you would expect: electricity, telephone, internet connections, water, sewer, all of that. And here, the next one is payment of interest on a covered mortgage obligation. This is a loan secured by both real property and personal property, but it has to be secured by property. Now, so you start with the amount of your specified expenses, and you're going to compare those against the amount of your loan. And maybe your specified expenses equal the amount of your loan. Great. Now you have to worry about two possible adjustments. And then there's just to make life more complicated, there's a cure feature for certain things. The adjustments fall into two categories. The first is it relates to your head count, and the second one relates to your compensation adjustments. I'll talk about those in more detail, but before I do, let me just introduce this idea of a cure. Many of you have had to furlough employees already, or you've had to reduce compensation because of your cash flow has been so adversely affected by the economic shutdown as a result of COVID-19. To the extent that those reductions, either in headcount or in compensation, have occurred between February 15th and April 26th inclusive, then you can eliminate the negative consequences of those adjustments by restoring or I guess reversing those reductions prior to June 30th. So if you reduce, let's just say hypothetically, let's say you reduced your headcount by 10%. If you hired everyone back, and it doesn't have to be the same individuals, but if your headcount was restored to 100% on June 30th, then the negative consequences of your prior headcount reduction, the one that occurred on or before April 26th, would not apply. Next, there's an adjustment. Well, here, I'll just sticking with headcount for a second. I'm sorry. So how do you measure headcount? And the first is you come up with a baseline number, and you can choose between two periods. One in the early part of 2019, February 15th, 2019 through June 30th, 2019, or alternatively, the period January 1 through February 29th, 2020. That gives you a baseline number of FTEs. Then the next thing you do is that baseline number becomes your denominator, and your numerator is the average FTEs employed during that 8-week measurement period where you're calculating what your specified costs are. And here I've just worked through on the slide just a very simple illustration. I don't want to go into it now, but the gist of it is that your baseline number or your FTEs during 8-week period over your baseline number yields a fraction. In my example, it's 80%, and then you apply that 80% to the specified expenses to reduce the amount of forgiveness. Next, there's a notion of if you've reduced compensation, and here what's interesting, it's not a dollar for dollar reduction, but it's the extent to which you've reduced compensation in excess of 25% during that 8-week period. And here we're focusing on individuals whose pay in 2019 was never annualized at more than $100,000. And so if this is important, you're trying to sort of pencil this out very carefully, look carefully at the statute in this area. You're looking at each pay period and you're asking the question, did the employee ever receive more than $100,000 in any pay period on an annualized basis? To the extent that your reduction in compensation exceeds 25% of total salaries for any employee described in that immediately preceding sentence. So any employee who in 2019 did not make more than $100,000 annualized, then dollar for dollar above 25% is a reduction in the amount of the loan that can be forgiven. Usually, if we were doing this live, I would pause and ask for questions, and there would no doubt be a ton. We'll have time at the end of this program for you to ask questions. A number of you asked questions online, and we're prepared to respond to those. How do you apply for loan forgiveness? Here, you're going to send your application to the lender, the same lender from whom you borrow. And the statute provides that the lender is required to make a decision on loan forgiveness within 60 days after the lender receives a complete application. So it's a relatively quick turnaround. How can you best position yourself to obtain a PPP loan? We talked to a couple of the more significant SBA lenders in our market and sort of the greater New England market. And the next couple slides reflect some guidance from them as well as our own intuition and sort of thinking about how a lender will be applying the statute. The challenge here is that the SBA has not issued any guidance. They propose to do so on an accelerated basis, and we're hopeful that guidance will come out this week. But as of the airtime today, there wasn't that guidance. So be looking for that. So first recommendation is contact your current bank or credit union. In other words, the bank with whom you have a relationship, the ones that are going to be most interested, who know you, most interested in working with you. But be patient. During the next several days, your lender may not know much more than you do. Second, remember that time is of the essence. There's a maximum dollar amount that the SBA can guarantee under the PPP program, $349 billion. Seems like a large number. There's going to be a flood of applications for PPP loans. You want to get in queue as early as you can. We assume that a lender will fund a PPP loan only if it first confirms that the SBA will guarantee it. And we don't know exactly how the SBA will handle that applications or requests for guarantees from different regions, but we're assuming it will look first come, first serve, but that'll be something that they'll probably address in their regulation. But the point is that it's in your interest to be positioned to be talking to your banker as soon as possible and to be gathering your information so you can submit your information as soon as your bank is eligible to receive it. So, as I said, we recommend you talk to your existing banks. We understand that some banks are planning on giving priority to existing customers and will look to make loans to new customers only if they're satisfied that that new customer, their existing relationship just isn't servicing the PPP program. If your borrower is not participating in the PPP program, then we recommend you thinking about who is an SBA preferred lender in your area. And probably, I'm not familiar with any specific list where all those lenders are categorized. There may be, but in our market area, the larger banks that you would expect. So I know Eastern Bank, for example, I know TD Bank, for example, and I'm sure there are others, are all preferred lenders. And that just means that they are particularly adept at making small business loans. So what do we recommend? We've talked about some of the criteria here, and just imagine kind of applying that criteria as you think about preparing your application package, so to speak. So you have to demonstrate that your number of employees doesn't exceed the specified limit. I use here in the slide 500, but remember, you might be eligible even if you have more than 500 employees, depending upon your criteria. And remember the comments from Beth Mitchell, where certain industries, accommodation and restaurants, you get to look at it on a per location basis. Also, there are special rules for franchises where you're not bound by the affiliation rules that generally apply under the SBA rules. But anyway, the point being is know your headcount. How many employees do you have? How do you document that? Second thing is know your payroll costs, because that's going to drive your the maximum amount of your loan. How do you demonstrate the amounts that are included and excluded from the payroll costs? And we've covered those for the most part in the slides. They're also set forward in the statute in a pretty straightforward way. So as you build your spreadsheet, take those costs into mind. Then, one suggestion is, to the extent you have your P&L for 2019 available, that would be a useful thing to have. But no one should not proceed in having a conversation with their banker because they don't have a P&L in place. I know that many small businesses probably were relying on their tax returns for 2019, and many of those have probably been delayed by the shutdown due to the COVID-19. Don't wait for your P&L. If you have it, great. If you don't wait. Lastly, if there will be a form, the standard form for SBA loans is Form 1919. We're told that there will be a modified version of Form 1919 that the SBA is expected to publish shortly. We've received questions from people registered for this program if we know when that will be. And I'm sorry, we just don't yet. But I would, look at the SBA site. There's a piece of the SBA site dedicated to the CARES Act, and more specifically the PPP program. And just watch for that, and I'm sure that it'll be prominently displayed when that's available. So with that, I'm going to hand it off now to Beth Mitchell. And Beth, if you can address the economic injury disaster loans that are treated a little bit differently under the CARES Act.
Yes, happy to do that. So what if a borrower can't obtain a PPP loan? What other options are available? And there are several other types of SBA loans, but I am going to focus just on one other, which is the economic injury disaster loans, rolls off the tongue as EIDL, and emergency grants. These people often think of in terms of natural disasters, but they are also available for dealing with COVID-19 injuries, if you will. And they are available in Massachusetts, and these loans are made directly by the SBA. Small businesses, nonprofit organizations of any size, and certain agricultural and aquacultural enterprises are eligible for these EIDL loans. And these loans are up to $2 million and are designed to help meet the financial obligations and operating expenses that could not have been met because of the disaster. The interest rate, generally speaking, on these loans is 3.75%, but nonprofits get the benefit of a lower rate at 2.75%. The loans are often with long-term repayment provisions up to a maximum of 30 years. One of the things that the CARES Act did was establish an emergency grant to eligible borrowers who've applied for an EIDL loan. And the grant can be up to $10,000 and would be distributed as quickly as 3 days after the request is made, again, by the SBA. If the application for the EIDL loan is denied, the CARES Act provides that the emergency grant does not need to be refunded. And again, the emergency funds can be used for the same kinds of expenses that we've been discussing: payroll costs, rent, mortgage payments, and the like. The CARES Act does not allow a borrower to obtain both a PPP loan and an EIDL loan for the same purposes. But if a borrower has gotten approved for an EIDL loan unrelated to COVID-19, it can still apply for a PPP loan and has an option to refinance the EID loan into a PPP loan. So I think that pretty well covers this other SBA program. And with that, I think I will turn this back to our moderators.
Thank you, Beth. At this time, I'd like to introduce our partner, Tom Curry, to discuss other related programs in the CARES Act. By way of introduction, Tom's a former Massachusetts banking commissioner and most recently, former comptroller of the currency appointed by President Obama. Tom, question for you. Are there programs under the CARES Act that will help mid-sized businesses?
Yeah, absolutely, Mike, and thank you for the introduction. What I'd like to talk about this afternoon is some of the programs to expand lending to small and mid-sized businesses that were created under Section 4003 of the CARES Act. And there are two important provisions there that support the small to mid-sized businesses by leveraging the Federal Reserve Board's liquidity programs and facilities under Section 13.3 of the Federal Reserve Act. This authority was widely used to great effect in the global financial crisis to support market liquidity in a variety of asset classes, and is being employed in full force under both the CARES Act and under the 13.3 itself. Importantly, the CARES Act allocates $454 billion to support and expand the Federal Reserve's existing and new programs and facilities under Section 13.3. It has an even greater impact because these facilities have a 10-to-1 leverage. That means that funding under Section 4003B3 of the CARES Act could support up to $4.5 trillion in loans, guarantees, and investments. Under the statute, the Federal Reserve is empowered to do three things: purchase obligations or other interests directly from issuers, purchase obligations or other interests in secondary markets, or to make direct loans, including loans or other advances secured by collateral. The two new small and mid-sized business related programs and facilities are actually specifically mentioned in the CARE Act. One is the Main Street Lending Program, and under Section 4003C3, it permits the Federal Reserve to establish a Main Street Lending Program or a similar program or facility that supports lending to small and mid-sized businesses, including any entity to which the Treasury Secretary's separate mid-sized business program makes a loan guarantee, or other investment. It's interesting to note that last week on March the 23rd, before the CARES Act was even enacted into law, the Federal Reserve announced that it would establish such a facility. In terms of timing, given the Fed's experience with establishing these facilities, it should be a relatively quick process to stand up. The second program is the Mid-Sized Business Program. And under the CARES Act, it permits the Treasury Secretary directly or in conjunction with the Federal Reserve to establish a mid-sized business program to provide direct financing to banks and other lenders that make loans to eligible businesses, including, to the extent practicable, nonprofit organizations with between 500 and 10,000 employees. These loans have statutory terms and conditions. The interest rate is set by statute, and it's set at 2% annualized interest. The Secretary, however, may waive principal or interest on direct loans for the first 6 months or for a longer period in his discretion. There are also 10 required good faith certifications. Eligible borrowers must certify, 1, that the loan is necessary to support the ongoing operations of the recipient, given the uncertain economic conditions. 2, the funds will be used to retain at least 90% of the recipient's workforce at full compensation and benefits until September 30th, 2020. 3, the recipient intends to restore not less than 90% of its workforce as of February 1st, 2020, and to restore all compensation and benefits to the workers of the recipient no later than 4 months after the termination of the COVID-19 public emergency or on January 31st, 2020. The recipient is an entity or business that is domiciled in and has significant operations and employees in the United States. 5, the recipient is not a debtor in a bankruptcy proceeding. 6, the recipient is created under the United States laws and has significant operations and a majority of its employees based in the United States. 7th, the recipient will not pay dividends with respect to the common stock of the eligible business or repurchase any equity security that's listed on an exchange of both the recipient or its parent while the direct loan is outstanding, except to the extent required under a contractual obligation that is in effect as of the CARE Act's enactment. 8th, the recipient will not outsource or offshore jobs for the term of the loan in 2 years thereafter completing repayment. 9th, the recipient will not abrogate existing collective bargaining agreements for the term of the loan and 2 years after completing repayment. And finally, number 10, the recipient must remain neutral in any union or organizing effort for the terms of the loan. Well, what's significant about these Federal Reserve programs are its ability to leverage the funds that are allocated under the emergency provisions of Section 4003. Mike, I'll turn it back to you.
Thank you very much, Tom. I want to segue for a moment to commercial real estate, introduce our partner, Paul Ayoub. Paul is the chair of the board of the Greater Boston Chamber of Commerce. He's a past president of the Real Estate Finance Association. He has a frontline view on how the commercial real estate industry is being impacted by COVID-19. Paul, what's your sense as to how this program is being received by the lending community and the business community, and what is on the ground impact that this act will have some element of helping the flow of commercial and real estate lending?
Thanks, Mike, and welcome to all of our clients and friends and colleagues on this call. We're so glad we could host this webinar for you. I think, first of all, this has been a real boost and relief for the entire business community, but it's not just this act. It's, as Tom mentioned, the Fed has had a playbook for past downturns, and what they have done this time is acted quickly. And so even, for example, as you know, last week, the Fed announced that it would include agency CMBS in its mortgage-backed security purchases. That's going to provide significant liquidity for banks. So it's been a series of programs and decisions that the Fed has implemented that has really helped to stabilize at least a sense of focus in the business community, in the real estate community, in the lending community versus panic. So this is a health crisis that's created an economic crisis. And I think what we're seeing is that people are approaching it. It's not anyone's fault. And in that context, this program has been a real boost. Well, I've talked to maybe 10 different banks today or over the weekend, and obviously everyone is putting back their playbook on SBA loans to get this ready, so when they have the guidance, they can hit the ground running, because everyone knows there's currently a limit to how much is available, although that could always go up. And so everyone's going to want to be in there first. So that's the first point. And the second is, and Tom and I will maybe touch base on this, there's been in the CARE Act and other regulations an easing of the ability to modify loans. So what we're seeing is that people in this time around are working collaboratively and cooperatively versus adversarially, say, in the early 90s or in some of our other downturns. So for all those reasons, it's been well received, but we still need the guidance. And people are trying to do the best they can with a lot of unknowns.
Thank you, Paul. Another question. All of us on this panel, and I suspect many in our audience, have been having to deal with liquidity issues and making sure they're conserving cash on their balance sheet, and it affects the entire food chain. And so the question for you is, how does the Act benefit lenders and borrowers in modifying existing loans? And Tom, I'd ask if you could take the first shot at that, and then Paul to follow, please.
I'd be happy to, Mike. First of all, I think we're fortunate in this pandemic financial crisis to have a much stronger banking industry. They have much greater capital levels and liquidity levels than they did in the last crisis, almost double actually in both categories. So they're in a better position to help keep liquidity flowing throughout the financial system. The second thing I'd want to mention is both Congress and the federal and state bank regulators have recognized the need, at least at the short term, to provide some encouragement of loan modifications. And they've done that in Section 413 of the CARES Act in terms of authorizing a temporary reprieve of the troubled debt restructuring requirements under GAAP. They've also clearly indicated to the regulatory community, and I'm speaking about banks, that loans that are not past due for 30 days as of December 31st of 2019 are not considered to be loan modifications for accounting purposes, and that it should not result in impairment purposes. That's a clear signal to the banking industry to make those loan modifications, especially during the immediate aftermath of the emergency declaration.
And so, Mike, what you're seeing with that is that there's optimal alignment between the Fed and the lending community, because this is allowing banks to do what really common sense would tell them to do. There's no point really in foreclosing, because first of all, it would be hard to go to a court and get a foreclosure. And second of all, who's going to buy the property? Or to evict a tenant, how you're going to replace the tenant. So I think what the Fed has done has aligned with the common sense realities on the ground of allowing the banks to allow these modifications without any detrimental consequence. And I know a few banks I spoke to today, for example, are taking in all of their requests and they're going to launch programs, sort of systematic programs for doing this and try to make it as uniform as possible as opposed to doing it one-off for each of their borrowers, because there are so many that are going to be requiring this. And again, I think what's keeping things, keeping people at bay and keeping things level-headed in between all the business community and the lending community.
Okay, thank you, Paul. This is Liam. I think at this juncture, we'd like to move on to the a brief description that of the expansion to the unemployment insurance relief benefits available. And I'm going to turn to my colleague Laura Martin from our Labor and Employment Group to address those provisions.
Thank you, Liam. The CARES Act allocates $250 billion to the states for unemployment benefits. This funding significantly expands the unemployment benefits scheme in three major ways. The Act relaxes eligibility criteria, it extends the duration of benefits, and it increases the amount of money people will receive. When states sign on to participate in the Pandemic Unemployment Assistance Program, the number of people eligible for unemployment benefits will increase. Notably, self-employed workers, gig workers, independent contractors, and those with insufficient work history are eligible if they have lost their job because of COVID-19. The duration of unemployment benefits varies by state, and in Massachusetts, it's typically about 26 weeks. But now, the duration of unemployment benefits can run for up to 39 weeks, dating back to January 27th, carrying us through to December 31st, the end of the year. Notably, the federal government has provided funding to incentivize states to waive the 1 week waiting period, allowing people to receive benefits sooner. And lastly, pandemic unemployment benefits allow anyone collecting unemployment to receive an additional $600 supplement per week on top of whatever the worker typically qualifies for with their state benefits. This additional benefit lasts for 4 months, beginning in April and ending in July. State unemployment programs will be fully reimbursed for the cost of this supplement. So let's apply this with some real numbers. In Massachusetts, unemployment benefits are usually about 50% of a person's regular pay per week. The statutory maximum is $823 a week, which is roughly what someone making about $85,000 annually would receive. So an unemployed person who makes $85,000 or more will receive up to $1,423 per week through the end of July. That's the $823 Massachusetts benefit plus the $600 federal supplement. The intent behind this flat fee payment is to allow the average worker to receive as close to 100% of their income as possible. But some workers will be in the position where they are receiving more than what they would typically be paid. For example, an individual making $50,000 annually would receive $1,080 a week. That's the mass payment of $480 plus $600, when if they were working, they would receive about $960 a week. So anyone making less than $50,000 annually will receive more money with this $600 supplement. But keep in mind, this payment is temporary and only extends through the end of July.
Okay, thank you very much, Laura. We are now going to move to the tax relief provisions. And with that, I'm going to ask my colleague, Melissa McMorrow, to address those issues for us.
Thank you, Liam. I'm going to talk about 3 general categories of tax relief in the CARES Act. The first one is payroll tax relief. The second is the relaxation of rules that were tightened in the 2017 Tax Cut and Jobs Act for certain business provisions. And the third one is relaxation of rules for individuals, particularly around charitable contributions and retirement benefits. All of the tax relief is short-term and generally applies through the end of calendar year 2020. Just to give you a size of scope of the tax relief, of the $2.2 trillion that you hear that the CARES Act amounts to, $300 billion of that is tax relief. The first one is a refundable payroll tax credit, which is applied to 50% of qualified wages. This credit applies if an employer's operations are fully or partially suspended, or if an employer sees a decline in gross receipts of more than 50% over the same period the prior year. You'll see that there are limitations on this credit, namely that if you have more than 100 employees, you are allowed to obtain the credit for your employees who are not working, basically. If you're under 100 employees, all of your employees count towards the credit. The credit applies only on the first $10,000 of wages. And so basically, if you're doing the math, that's about $5,000 per employee. One thing I want to make sure people understand about this credit is that it's a refundable payroll tax credit, which is the same nature of the payroll tax credit in the Family First Coronavirus Act. And specifically, basically, if you, under this credit, have the ability to, say, for example, get $10,000 back in your credit, but you only have a payroll tax liability of $8,000, you're entitled to basically a refund check from the IRS for that $2,000 difference. The IRS is promising fast processing of these payments, but you do have to apply for basically a refund. The other payroll tax provision is a deferral of payroll taxes for all payroll taxes and also for self-employment taxes for the period beginning in March through the end of 2020. Those amounts are not forgiven or are not a credit, but they must be paid back over a longer period of time, half by the end of next year and half by the end of 2022. On the business tax relief, these provisions deserve more than a highlight, but in the interest of time, I will just highlight the fact that basically these two provisions that are on the screen here were provisions that were tightened up in the 2017 Tax Reform Act in order to pay for some of the other tax relief that was obtained in that act. But basically, for this 2020 period, the ability to have more generous use of your NOLs and also on your expensing of business interest has been restored for a temporary period. One other provision, business tax provision that I will note that is not here is the technical glitch fix in the qualified improvement property, which basically allows for bonus depreciation for tenant improvements, and that was a welcome relief. The next, just closing it out on the tax front, I want to highlight a few provisions that were applicable to basically retirement funds, employee benefits, and charitable contributions. First, if an employer pays an employee's student loan obligations, that employee does not have taxable income for the amount that the employer pays on the employee's behalf. And then on the qualified retirement plan front, there is relief from the required minimum distribution rules, which do not have to be taken in 2020, a waiver of the 10% penalty on early withdrawals from retirement plans up to $100,000, and also some increased flexibility for loan from these plans. Finally, on the charitable contribution front, the maximum deduction for charitable contributions to public charities typically is 50%. It's boosted back up to 60%. And a taxpayer who does not itemize may be allowed to take a $300 charitable contribution credit during 2020. Back to you, Scott.
So at this point, we're done with our formal presentation, and we'd like to turn it over to a question and answers. Many of you have previously submitted questions to us in advance. We have questions coming in now on the chat, and so we'll try to get through these as many as possible during the allowed time period. The first question that I'd like to direct to Beth, if you don't mind, Beth, is question came in is, how is the hospitality industry impacted by the CARES Act?
So the hospitality industry is one of the small number of industries that have the benefit of more flexible affiliate rules. If you recall back to one of the earlier slides, while the PPP program generally will look at the number of employees based upon all affiliates, there is an exception for the food services and accommodation sectors. And so for those businesses, the employee count can be looked at property by property. So if there's a hotel that has 300 employees and a second hotel that has another 300 employees, each would fit under the 500-person threshold.
Great, thank you.
Okay, we have another question that came in here that perhaps Mike Krebs, I'll ask you to entertain. Question was, where can a list of banks that could be utilized to apply for the loans, especially nonprofits, be found?
Thank you, Liam. So I'm not sure that there's a distinction between not-for-profits and other business entities. But as I mentioned, we recommend that you start with your existing banking relationship. Even if you don't have a borrowing relationship, if you have a banking relationship, they know you, you're a customer there, ask them first if they're going to be participating. If they're not planning on participating in a PPP program, then I would look for banks in your region that are designated as SBA preferred lenders. There's no magic to that, but it just means that they're probably more facile, more nimble in dealing with SBA programs generally, and they'll probably have the staffing in place to respond quickly. As Paul Ayoub mentioned, we're hearing from a number of banks where they're trying to build policies and procedures where they can treat their customers similarly. And the larger banks, I think, will be able to build out those policies and procedures faster than the smaller banks. But the advantage of a smaller bank is that they may know you and they may be more helpful in terms of helping you understand the program. So as I said, start with the bank you know, and if you need to go beyond that, look for banks that are SBA preferred lenders.
Yeah, and I'd like to just jump in. I'd like to jump in there and just state perhaps the obvious, which is, and as I'm sure most people are doing, is to be on the phone now to figure out what your options are. There is a limited amount of funds. Everyone's going to be going after them, and if you don't have a bank that is doing this, there could be a challenge in the marketplace to find an alternative. So I think the advice is to be proactive now while the programs are being set up.
Thank you, Mike. The other question that came in is, do nonprofits receive favorable terms under PPP? Tom or Beth, could you address that question?
I can tell you that under the EIDL loan program, not-for-profits get the benefit of a lower rate. I'm not aware of any particular different treatment of not-for-profits under the PPP program.
Okay, Mike, another question I think that is probably best posited to you is the question has come in determining employees whose compensation exceeds 100,000. I know there was a number of costs that would be included in this, but in determining whether a compensation exceeds 100, does the prospective borrower include bonus payments?
Thank you, Liam. The answer is yes. So think of wages and compensation broadly, and it's not just base salary, but it's base and bonus, really anything that would go into box 1 on W-2. So the entire compensation for the employee is taken into account in asking the question, did they receive compensation in excess of $100,000? Or I mentioned there was that provision where you have to sort of look at, for 2019, was there any pay period where they received more than $100,000 annualized? And you're looking at all compensation, base, bonus, et cetera.
Thanks, Mike. Another question from the audience. Do any of the stimulus programs allow for loan forgiveness if the payments are to independent contractors who are not paid with W-2 reporting and withholding? I am a single member limited liability company, disregarded for tax purposes. I do not pay myself a salary, but make regular estimated tax payments. Am I eligible for loan forgiveness if I begin to take a salary equal to my past earnings? Melissa, is that something that you could? Yeah, that'd be great.
I can take that. The treatment of single member LLCs is something that would be great to have some clarification on, but absence guidance for tax purposes, as long as that single member LLC is treated as what we call a disregarded entity and not as a corporation, then I would suggest that you would follow the rules for sole proprietors or independent contractors, and that would be looking at the $100,000 max.
Okay, we have another question, Mike Krebs, touching on the loan. If we have furloughed employees, would an entity be required to bring them back when the loan funds, before it funds, or never have furloughed them to begin with?
So Liam, the not having furloughed employees is not a condition of the loan. So the eligibility criteria is really very basic. Were you in business in February? Did you have a payroll? And do you have less than the specified number of employees, typically 500 employees, subject to some of the nuances we've talked about in the program? Where it becomes a little bit trickier, that fact pattern, is that it may affect your ability to obtain loan forgiveness. But two things to keep in mind. First is, if those employees were furloughed prior to now, and you were to bring back a like number of employees on or before June 30th, you in effect can eliminate the adjustment to the forgiveness amount based upon your FTE reduction. But those provisions are really complicated, and you just need to kind of work them through based upon your particular facts. But just to sort of wrap up, the mere fact that you've furloughed employees prior to now, or you have to furlough employees in the coming weeks, does not preclude you from participating in a PPP program. The point is, you'll have to certify that the loan will be used to support ongoing operations. And so whether it's payroll of remaining employees or rent or utilities, that's where the money will be going. Liam, back to you.
Okay. We have another question here that maybe I'll pose to Melissa. Are the loan forgiveness benefits available under the PPP and the deferral of payroll taxes mutually exclusive, or can an employer benefit from both?
So the person taking a triple P loan does not have access to the employee retention payroll tax credit, but I believe does have the ability to defer the payroll taxes.
Okay.
Melissa,
Laura,
one other question.
Go ahead, Mike. Yep.
Yep. Another question that probably you're best apt to answer is, for PPP, can employer payroll taxes be included in the monthly payroll expenses? Also, can payroll service fees be included?
So state level, yes. There's no specific guidance on the payroll service fee, and federal payroll taxes cannot be counted. So Social Security taxes, no.
We have a question here on unemployment comp, and Laura, perhaps ask if you can address this. Question, has the Commonwealth extended the unemployment benefits to the self-employed?
Happy to, Liam. As of now, the Massachusetts Department of Unemployment is not currently accepting applications from those who are self-employed. When I looked on the website earlier today, there's a message posted stating that the department is waiting on guidance from the federal government. So going forward, assuming that Massachusetts adopts the federal rules and signs on to the Pandemic Unemployment Assistance Program, and I do not foresee why they would not, a self-employed person will be eligible for unemployment benefits in the future, but not at this particular time.
Thank you.
Mike, I have a question coming in from the audience that probably is best suited for you. What was the period of time you could choose to determine average payroll expenses? You mentioned 2 time periods.
Sure. So there are 2 different periods depending upon what you're focused on. So let's focus on how you determine the maximum amount of your loan. So that's 250% of your payroll costs. And that's for the 1-year period prior to the loan being originated. And if we imagine these loans will be originated sometime in April, you don't know exactly when that's going to be, but if you're just for planning purposes, what we've been advising clients to do is just use the 12-month period ending tomorrow, March 31st, and that will give you a pretty good sense of what your maximum loan will be. So use the payroll costs for that period. Then when we're calculating forgiveness, it gets a little bit more complicated. You can look at the period, you have choice as to what period you're covering, but the focus will be for payroll reduction is the 8-week period after the loan is dispersed. And the question you're asking is, for employees that were part of your FTE group during that 8-week period, have you reduced the compensation of any individual whose annual compensation is $100,000 or less annualized by more than 25%? And if you have, then there's a dollar for dollar reduction in the amount that may be forgiven in excess of 25% reduction in compensation. And so there, you're looking at first you identify who the employees are that are part of the relevant universe, and then you're asking the question, for those individuals have you reduced their compensation by more than 25%.
Great, thank you, Mike. Maybe you want to take the next one?
Yeah, so we have a question here, Mike, probably best addressed to you as well. Should a business start the application process, even if the business is considered essential and is still currently working in anticipation of maybe not being able to, but take the loan out in anticipation and perhaps of not being able to work due to client contract cancellations and such?
Boy, that's a great question. The answer may depend a little bit on the really specific facts and circumstances. Remember, you need to make 3 certifications. And the first of those is that your business has been adversely affected by COVID-19. And so if you're anticipating that your workforce is going to have, that your contracts are going to be terminated, and therefore your cash flow will be adversely affected, and you're anticipating that you're going to be harmed as a result, and that's all reasonably foreseeable, then I would think it would make sense to consider applying. My sense of it is that the banks who are processing the PPP loans will be relying on these certifications. They'll be asking for some backup documentation, but I don't think anyone's going to be doing an audit. In fact, I read today that Treasury Secretary Mnuchin was hopeful that the process could become so streamlined that banks might be able to fund the same day they receive a PPP application. That strikes me as optimistic, but it does give you a sense of the policymaker's point of view here, which is let's get the money out the door quickly. And so I think if you can make that good faith certification that you've got an impending economic adverse effect because of COVID-19, then it seems to me you ought to be thinking about making an application.
Okay, thank you.
So Mike, sorry to keep on picking on you. Another question I think you're probably best suited to answer. If you can't calculate average payroll for 1 year because you started your business on 1/1/2020, what do you use to calculate average payroll for PPP purposes?
I have to confess that I don't know the answer. My intuition is that it's going to be you use the period that you have available to you, and you know you're looking to arrive at a monthly average, and so I think you just use the available period and you arrive at your monthly average based upon the actual time elapsed during the 12 months prior to the loan being dispersed. So that's the best you can do. More interesting question, and we have to sort of take a look at the statute to see if this nuance is picked up, is if you had ramp-up costs. So let's say you've got 3 months of operating history, and in month 1 you had hardly any, and your costs ramped up significantly in months 2 and 3. How does that play into account? Don't know the answer to that. I do know that the way the law was developed, and as we all know, it came together pretty quickly. Some of these nuances aren't all that well addressed. The SBA, working with Treasury, will be developing some regulations, and they have the ability under our federal administrative procedures law to implement interim emergency rules that can take effect right away. So just watch for guidance on some of these nuances.
Okay, thank you, Mike. Question that maybe is best posed to Beth. Beth, there's a question here as to whether an entity can apply for both a PPP loan as well as an economic injury disaster loan at the same time.
So I think the answer is that yes, you can apply for both, but you can't necessarily obtain both. And remember that the EIDL loan is capped at $2 million. So if the PPP loan were to be for a larger sum, then presumably you would take the PPP loan instead. But if you got one of the emergency grants, the emergency grant would, you'd have the benefit of the emergency grant even if you subsequently got the PPP loan.
Okay, thank you. Mike, do you have one?
I have a question regarding the unemployment benefits, and the questioner asks, when will the unemployment $600 supplement go into effect? Perhaps Laura or Melissa can address that one.
Hi, it's Laura. It will go into effect in April, and it will run for 4 months through the end of July.
Okay, thank you, Laura. We have another question about the PPP. So I'll perhaps ask Mike to handle this, but question as to whether there's been any guidance yet issued as to how an entity would support the proposition that the loan is necessary to support business.
So thank you, Liam. I don't know that the short answer is there's been no guidance on that point. And so I think that we'll just watch to see what regulations the SBA will come out with, what guidance they'll come out with. That will be in the first wave. I know that generally speaking, the banks are indemnified in terms of relying on these self-certifications by the borrowers. But I think as you think about it, it has to pass a straight face test, and you should be prepared to sort of document why it is it's necessary to support your operations. But I think that the best answer is stay tuned, and I would expect that perhaps as early as this week, there'll be guidance on that point since it's so critical to the application process.
Okay, thank you, Mike. We have another general question that perhaps one of our real estate partners can address. Tenants just looking for perspective, what you see going on in the industry with respect to rental payments and how tenants are handling that with landlords.
Beth, why don't I start? Maybe you can weigh in.
Sure.
It's all across the board. The key here has been communication, and there has been a lot of it. So we have seen some landlords, there have been some landlords, and I've seen this from the owner point of view, as well as the lender point of view, and getting requests from borrowers who have proactively agreed to forbear from collecting current rent, either absolutely for a few months or in exchange for something, some concession or some other negotiation. But there's been a lot of direct communication about this. And some, it's only now is going to be April 1st this week. So I think a lot of both owners and tenants were sort of on a wait and see for this month, because this is really the first month when rent will be due during COVID-19. And the part of it that's keeping everyone together is this like a centrifugal force, because if tenants, if they're not paying the rent, landlords are somewhat forced to try to negotiate, because it's not like you can vacate the premises and fill it with someone else right now in most cases. So it's really a case-by-case basis, but generally speaking, there's been a lot of communication and a lot of dialogue and a lot of negotiation. But Beth, what are you seeing on your end?
Yeah, I mean, I think one of the things that you also have to do is differentiate by product type. So the CARES Act does deal with multifamily properties differently than it deals with other kinds of commercial properties. And there are some requirements in the CARES Act in section 4023, 4024, dealing with the requirement to forbear for certain periods of rent, and also limiting eviction ability, even if the courts were open, which for the most part they are not. But if you're dealing with an office property, a industrial property, other kinds of commercial real estate, then the CARES Act really doesn't affect the arrangement between those landlords and tenants.
Thank you, Beth. With only having a few minutes left, I wanted to open it up to a question to our partner, Shannon Zollo, who heads up our mergers and acquisitions practice. Last year was a very robust year for mergers and acquisitions here at Nutter and elsewhere. And Shannon, I was hoping that you could generally address what you're seeing as being the impacts from the COVID-19, and whether you think the CARES Act is going to have any effect on the dynamic we're seeing in the marketplace.
Thanks, Mike. So, as with everything else that's been discussed today, the M&A market has been affected by COVID-19. I was just on a call earlier today for a private equity recap in which our client is a target of a private equity-backed acquirer. And because of the tightening in the credit markets, the acquirer indicated that there would have to be a restructuring of the proposed deal from the previously negotiated LOI. In other words, there wasn't enough debt available to help facilitate the transaction as it's currently contemplated. That's an anecdotal data point, but I think it is representative of what many of us in the M&A market are seeing, whether we're on the buy side or the sell side. The lowering of the interest rates should help to stabilize lending activity as it relates to M&A, although it is going to take some time for the ripple effects of the Fed cutting rates last week or 2 weeks ago at this point to manifest itself in those deals and the structuring of the credit piece of those deals. But that's much better than where we were 10 years ago during the financial crisis and the risk profile that currently exists on these deals relative to what was the case 10 years ago. In terms of the CARES Act itself and the impact it's having on M&A, it's still early in the process, obviously, but a number of our private equity fund clients, as well as venture capital fund clients and their portfolio companies, are looking to the CARES Act to help stabilize their operations, even if they're not midstream in an M&A transaction, but to position themselves so that they can survive through the crisis, get on the backside of it, and then commence whatever M&A activity they may have previously been contemplating. Obviously, those funds are subject to some of the aggregation rules that Mike Krebs and Beth Mitchell had discussed earlier in the webinar in terms of the 500 employee limit. But assuming that they can navigate those rules and make use of the funds under the PPP provided by the CARES Act, those portfolio companies should be able to weather the storm, hopefully, to get to the point where they are continuing to conduct M&A. So long story short here, as it relates to M&A, those deals that are currently under LOI or were close to under LOI pre-pandemic appear to be proceeding, albeit under potentially a different structure, depending on what's happening with the credit piece. But the CARES Act and the PPP specifically should help other companies that may have been contemplating some M&A activity to stabilize, get through this shock period, and then get back to hopefully more normal activity as it relates to M&A. Back to you, Mike.
Thanks, Shannon. This is Liam. I got one here that was specifically addressed to Tom that might be of interest. Tom, two-part question. Given your experience as a bank supervisor through the financial crisis, what indicators do you view as critical for us to observe in order to determine whether the economy is returning to a fully functional state? And then second, do you anticipate a different recovery pattern or path because the cause of the slowdown is external to the financial system?
Thanks, Liam. From a economy signal turning point, I think it's really, we have to look to the cause, which is really a public health cause. I think we've developed through the CARES Act and some of the Treasury and Fed's responses, the ability to provide liquidity over the short and medium term. We really need to be able to address the underlying pandemic issues in terms of testing, being able to get people to work safely again. And I think the economy recovering is really contingent on that external event, which drove the crisis in the first place. Again, I think several economists have speculated on what type of recovery it would be. I think initially the thought was that it would be a V-shaped recovery, predicated, I think, on the ability to quickly address the pandemic. As we've extended some of the emergency measures out through April, that may end up being a much slower recovery, more in the shape of a U.
Okay, thank you, Tom. We're right up against the time that we had allocated for this, and we want to be respectful of everybody's time. So I think at this point, we'll end the webinar with a thank you to all for your attendance. Those of you who are clients, thank you for the trust and confidence you place in us. We will make available a recording of the webinar as well as the slide deck to all those that participated. And we invite you all to visit the Nutter website. We do have all of our alerts and client communications by way of keeping those informed of changes to the law and the rest posted there. And we invite you to make use of them. So thank you all very much for attending, and everybody stay well.